In cities where multi-million-dollar homes once sparked bidding wars and sold in days, the scene has changed. Price cuts are frequent, open houses draw few visitors, and high-end properties sit unsold for months. This isn't the entry-level market, it's the top tier. Glass penthouses with pools, marble kitchens, rooftop decks, theaters, and garages for multiple luxury cars. Once considered bulletproof investments, these homes are now repeatedly relisted, often discounted by hundreds of thousands, with some quietly marketed off MLS at steep markdowns. This isn't a gentle slowdown. Taxes and insurance have risen, mortgage rates are high, and fewer buyers can handle six-figure annual costs. On Discover the Cities, we're counting down 10 U.S. cities where luxury home prices are dropping fastest. Stay tuned. The number one city is losing wealth at rates reminiscent of 2008. If you haven't subscribed yet, now's the moment. This luxury correction is just one part of a broader housing reset we'll track closely. Number 10. Dallas, Texas. For a long stretch, Dallas was showcased as one of Texas's biggest luxury real estate wins, a place where upscale living seemed to thrive without interruption. Prestigious neighborhoods such as Highland Park, Preston Hollow, and Turtle Creek drew in corporate executives, seasoned investors, and out-of-state buyers searching for larger homes, top-rated schools, and the kind of status that comes with a prime address. During the height of the boom, properties priced between $2 million and $5 million were often snapped up before they even appeared on public listing sites. By 2022, the top 10% of sales had driven the city's luxury median price beyond $1.3 million. A steady stream of new residents combined with strong job growth reinforced the belief that demand in Texas, especially in Dallas, would remain unstoppable. Fast forward to 2026, and that confidence has clearly weakened. Many of those same high-end homes are now selling closer to $1.05 million, marking roughly a 20% drop in just 3 years. In the $3 million and up bracket, price reductions of $500,000 to as much as $1 million have become increasingly common. Listings that once ignited bidding wars are now highlighting price improvements and offering serious concessions just to attract attention. The first major issue is oversupply. When the pandemic housing surge was in full swing, developers leaned in aggressively, breaking ground on expansive custom builds and upscale condo projects. Today, Dallas is facing nearly 10 months of inventory for homes priced above $1 million, a level that signals a clear imbalance between buyers and sellers. The second pressure point is cost. With property tax rates hovering around 2.2%, a $2 million home can generate an annual tax bill of roughly $45,000, and that's before factoring in insurance or maintenance. After multiple severe storm seasons, insurance premiums have climbed sharply as well, with many luxury properties now paying $12,000 or more per year just for coverage. When you add it all together, the monthly carrying costs on a high-end Dallas property can easily exceed $10,000. Meanwhile, comparable luxury rentals may only bring in around $6,000 per month. The financial equation that once made these purchases feel secure and strategic simply doesn't pencil out the way it used to. Some investors are choosing to ride it out, hoping for a rebound. Others are deciding to cut their losses and exit. Foreclosures in the luxury tier, something that used to be extremely rare, are now beginning to show up in data from Dallas and Tarrant County. From a distance, the skyline still features cranes and new development, giving the impression of ongoing momentum. But beneath that surface, Dallas's high-end housing sector is quietly turning into a case study of how quickly a red-hot Texas market can pivot into a difficult and humbling correction. Number 9. Miami, Florida. For more than 10 years, Miami branded itself as America's ultimate luxury escape, a place where wealth met sunshine and waterfront views. Think penthouses hovering above Biscayne Bay, sprawling estates in Coral Gables and Miami Beach, and sleek glass towers rising along Brickell, all promising a resort-style lifestyle high above the city. Between 2020 and 2022, that vision reached a fever pitch. Affluent buyers from New York City poured in, drawn by Florida's tax advantages and year-round sun. Californians, frustrated by soaring living expenses, followed close behind. International capital from Brazil, Argentina, and across Europe flowed into the market as well. The appreciation was dramatic. A condo purchased for $1.5 million in 2019 could easily resell for $2.4 million just 3 years later. Waterfront mansions didn't just rise, many of them doubled in value in record time. Now, that explosive growth has shifted into reverse. By 2026, average prices across many luxury condo developments have fallen more than 20% from their highs. Units that once attracted multiple offers within days are now sitting idle. A condo that previously commanded $2 million is struggling to close at $1.55 million. Waterfront estates initially listed at $5 million are trimming down to $4 million or less, and still waiting months for a buyer. This isn't just a cyclical dip. The pressures run deeper. From 2018 through 2024, developers added tens of thousands of new high-end condo units to the skyline. Supply expanded far more rapidly than the base of committed, long-term buyers. At the same time, Florida's insurance challenges have dramatically altered the cost of ownership. Policies that once ran around $15,000 annually are now exceeding $40,000 for many waterfront properties. Condo associations haven't been spared either. Monthly HOA fees of $1,500 have become standard, and in some luxury towers, dues surpass $2,500 per month before a single mortgage payment is made. Investors who depended on short-term rental income are feeling the squeeze as well. Occupancy rates for upscale vacation units have dipped below 55% in many cases, while nightly rates have fallen roughly 20% from their peak. Add in global economic uncertainty and elevated U.S. interest rates, and many foreign buyers have decided to wait on the sidelines. The impact is visible after dark. Entire sections of once buzzing towers sit unlit. Second and third homes left empty, reminders of a buying frenzy that has cooled. The sun still shines over Miami. The skyline still glitters. The ocean views haven't changed. But the financial structure built around that lifestyle is under strain. In the luxury tier, the city is moving away from relentless growth and into a serious reality check, one that's testing just how many buyers can truly afford to remain in the market. Number 8. Scottsdale, Arizona. Scottsdale has long marketed itself as the desert's answer to high-end living, Arizona's capital of upscale real estate. The formula was simple but powerful. Gated golf enclaves, sprawling hillside estates, and luxury condos tucked near Camelback Mountain, where buyers weren't just paying for square footage, but for a curated lifestyle of sunshine and exclusivity. At the market's height in 2022, the median price in the luxury tier hovered around $1.2 million. Not long after, that figure slipped to roughly $975,000, a decline of about 19%. In the $3 million and up category, price reductions of $500,000 or more have become routine rather than rare. The underlying issue isn't complicated. There are simply too many high-end properties and not enough qualified buyers to absorb them. Between 2018 and 2022, developers moved aggressively, rolling out upscale golf communities and resort-style neighborhoods at a rapid pace. By 2026, inventory for homes priced above $1 million has climbed past 9 months, well beyond what would be considered a balanced market. Homes that once found buyers in under 3 weeks are now lingering for 100 days or more. That shift gives buyers negotiating power and forces sellers into repeated price cuts to stay competitive. At the same time, the cost of owning these properties has risen sharply. Insurance premiums have surged as wildfire threats, flash flooding, and higher construction expenses push annual coverage from around $3,000 to $7,500 or more for many homes. Meanwhile, mortgage rates north of 7% have dramatically altered affordability. A $1.5 million home that once carried a monthly payment near $6,200 can now exceed $9,200 under current conditions. The short-term rental strategy that once seemed like a safety net is also losing traction. Scottsdale's reputation for golf getaways and winter retreats attracted investors who counted on vacation income to offset expenses. By 2026, occupancy rates for many upscale rentals have slipped below 50%, and nightly pricing has fallen by roughly 15% from peak levels. For an increasing number of owners, the numbers just don't add up anymore. Foreclosures haven't reached crisis levels, but they are beginning to surface in North Scottsdale and other affluent areas where buyers stretched financially to secure $2 million estates. Even a modest dip in value can push those homeowners into negative equity territory. The golf carts still cruise through manicured communities. The sunsets still glow over the desert. The spa days and resort amenities haven't disappeared. But beneath the polished image, the economics have changed. Luxury property in Scottsdale no longer looks like an effortless path to wealth. Instead, it's starting to resemble an expensive commitment that far fewer buyers can confidently afford to maintain. Number 7. Los Angeles, California. For generations, Los Angeles has been viewed as the epicenter of American luxury real estate. From the sprawling mansions of Beverly Hills to the oceanfront estates of Malibu and the sleek glass architectural homes perched in the Hollywood Hills, LA became the visual definition of ultra-wealthy living. When people imagined multi-million-dollar homes, this was the backdrop. At the market's height in 2021, the median price for luxury properties across Los Angeles County reached approximately $3.2 million. By mid-2026, that figure has retreated to around $2.55 million, a decline of roughly 21%. At the highest tier, homes originally listed above $10 million are now trimming $2 to $4 million off asking prices just to attract qualified buyers. Multiple forces are colliding at once. Years of speculative development created a surplus of trophy homes that today's buyer pool simply can't fully absorb. Meanwhile, property taxes and the overall cost of living, already among the highest in the nation, have continued to climb. With mortgage rates holding above 7%, financing a $15 to $20 million estate now translates into staggering monthly payments, even for households with substantial incomes. Insurance has become another major strain. In wildfire-prone areas like Malibu and parts of the hills, annual premiums, already steep, are now exceeding $100,000 for some large properties. Gated communities in the hills are also raising homeowners association dues as they allocate more funds toward fire mitigation, private security, and ongoing maintenance. At the same time, the economic base that once fueled this segment has softened. Layoffs and production slowdowns in the entertainment industry, changes in tax incentives, and the normalization of remote work have reduced the number of local buyers willing to tie up enormous amounts of capital in a single residence. International investors who were once consistent participants in this market have stepped back amid currency volatility, global uncertainty, and tighter lending conditions. The rental fallback plan isn't as dependable as it once was either. Luxury rental rates have plateaued, and many municipalities have imposed stricter short-term rental regulations, weakening the old vacation rental strategy. Owners who expected to offset expenses by leasing their properties part-time are discovering that income streams are far less predictable. The shift is becoming increasingly visible in some of the nation's most iconic neighborhoods. Instead of quiet, discreet, off-market transactions, there are public price reductions. Listings linger. Foreclosures, once almost unheard of at this echelon, are beginning to surface in places like Beverly Hills and Calabasas. The long-standing narrative that Los Angeles luxury real estate only appreciates is starting to fracture. Beneath the red carpets and ocean views, the financial realities have changed. And even Hollywood can't script its way around basic math. Number 6. San Francisco, California. For a long time, San Francisco stood as a symbol of West Coast affluence fueled by the tech boom. Startup founders, corporate executives, and venture capital insiders drove prices skyward in elite neighborhoods like Pacific Heights, Noe Valley, and Russian Hill, along with sleek downtown high-rises packed with luxury condos, many of them purchased as second homes or long-term investments. At the market's high point in 2020, luxury home values hovered around $3.5 million. By 2026, that median has fallen to roughly $2.75 million, marking a decline of about 22%. In certain downtown condo buildings, prices have dropped even more sharply, with some units down nearly 30% from their peak. A combination of pressures is driving the shift. Widespread tech layoffs have reduced the number of high-earning buyers able, or willing, to compete for multi-million-dollar homes. The normalization of remote and hybrid work has also lessened the need to live close to downtown offices. Many former city residents have opted for more affordable suburbs or relocated to entirely different states. Buyer hesitation is compounded by concerns over public safety, visible homelessness, and retail vacancies in parts of the urban core. For someone considering a $3 million purchase, those quality of life factors matter. Meanwhile, ownership costs remain substantial. On a $3 million property, annual property taxes can easily surpass $35,000. Earthquake insurance, often viewed as non-negotiable in the Bay Area, may add another $15,000 or more per year for a sizable home. Inventory is climbing at the same time demand is cooling. High-end condos that once sold in a matter of days are now lingering on the market for 200 days or longer. Developers who previously assumed that tech wealth would continually absorb new construction are now offering incentives that would have seemed unthinkable a few years ago, covering HOA dues for extended periods, including premium upgrades, and offering generous commissions to buyer agents. Even with those incentives, activity remains muted. Investors are approaching deals more cautiously. Luxury rental rates in some segments have fallen around 18%, eroding the returns that once justified sky-high valuations. Without strong rental income, the financial logic behind many purchases no longer holds. Distressed sales and occasional foreclosures are quietly surfacing in neighborhoods that once appeared immune to downturns. For years, the upper tier of San Francisco's housing market was treated as virtually untouchable. The current correction serves as a pointed reminder of the risks that come with tying real estate too closely to a single dominant industry. When that industry contracts, the property market connected to it can unwind faster than many expect. Number 5. Aspen, Colorado. Aspen has always represented one thing above all else: rarefied, ultra-high-end exclusivity. Ski chalets routinely listed between $10 and $20 million. Secluded estates tucked deep among the trees. Condominiums priced higher than entire homes in major metropolitan areas. For years, the prevailing belief was straightforward: there would always be enough ultra-wealthy buyers to push values higher. By 2026, that confidence is beginning to fade. Luxury property prices in Aspen have declined nearly 18% from their 2022 peak. A chalet that might have commanded $12 million at the height of the boom is now closer to $9.5 million. Vacation condos that once sold for $4 million are changing hands nearer to $3.2 million. These aren't isolated markdowns. They point to a broader cooling in demand. The pool of buyers who once purchased Aspen real estate at almost any price has noticeably narrowed. Elevated interest rates have increased borrowing costs across all price tiers, including the very top of the market. At the same time, many global high-net-worth individuals are diversifying, allocating capital to European resorts and other mountain destinations instead of concentrating heavily in one Colorado enclave. The cost of ownership has also climbed significantly. Property taxes, wildfire insurance premiums, and substantial community association fees in exclusive ski neighborhoods can easily add six figures annually to the expense of maintaining a large estate. Owning an Aspen is no longer just about the acquisition price. It's about sustaining the ongoing financial commitment. Investor appetite has softened as well. Stricter local regulations on short-term rentals have limited flexibility, and revenue from high-end tourism has dropped more than 25% in certain segments. The financial equation that once justified trophy home purchases no longer looks as reliable or predictable. Homes that previously would have sold within weeks are now lingering on the market for 200 days or more, a remarkable change in a town where even 30 days once felt slow. While foreclosures remain uncommon, the fact that they are appearing at all carries symbolic weight. Aspen's long-standing image as a guaranteed sanctuary for wealth is being challenged. When the numbers begin to shift, even in a place defined by extreme affluence, market sentiment can turn surprisingly quickly. Number 4. The Hamptons, New York. For decades, the Hamptons have symbolized summer luxury for New York's wealthiest circles. Picture classic shingle-style estates tucked behind towering hedges, winding driveways that open onto private stretches of beach, and quiet roads where household staff often outnumber year-round residents. For a long stretch, it felt like demand would never dry up. Luxury pricing reached its high point around 2021, when the median climbed to roughly $3.2 million. By 2026, that figure has eased down to about $2.6 million, an 18% slide. At the very top end, oceanfront compounds that once asked $20 million are trimming $3 to $5 million off their price tags just to draw serious buyers. Two major pressures are reshaping the market: oversupply and staggering carrying costs. During the pandemic, affluent buyers from New York City surged eastward, and developers responded quickly with a burst of new construction. A wave of high-end homes hit the market in a relatively short period. Now, the upper tier in the Hamptons is sitting on nearly a full year of inventory. Properties that previously sold within weeks are lingering for 6 months or longer. Meanwhile, the cost of maintaining these estates has become increasingly burdensome. On an $8 million property, annual taxes alone can top $120,000. Add hurricane and flood insurance, often exceeding $50,000 per year. And then factor in staffing, landscaping, security, and routine upkeep. Altogether, yearly carrying expenses can easily range between $300,000 and $500,000. In the past, summer rentals helped offset those costs. But that cushion is thinning. The short-term rental market has become crowded, pushing weekly rates down by nearly 25% in some areas. Even during peak season, vacancies are more common than they used to be. Foreclosures, once almost unimaginable in this enclave, are beginning to surface as lenders quietly repossess multi-million-dollar properties. The Hamptons have long thrived on scarcity, prestige, and steady demand. Now, they stand as a vivid illustration of what can happen when ownership expenses surge while the pool of buyers and renters contracts at the same time. Number 3. Las Vegas, Nevada. Luxury real estate in Las Vegas has always been about showmanship and drama. Think soaring penthouses overlooking the Strip, sprawling desert estates with illuminated pools, and gated hillside enclaves designed to impress the moment you arrive. At the peak in 2022, the median price for high-end homes hovered around $1.1 million. By 2026, that number has slipped to roughly $880,000, a decline of about 20%. Properties priced above $2 million are regularly dropping $400,000 to $600,000, yet many still sit unsold for months. The reasons are familiar: too much supply at the top end and rising costs limiting demand. During the pandemic boom, developers assumed high earners and investors would continue pouring in indefinitely, so luxury communities expanded rapidly. By 2026, Las Vegas is carrying nearly 11 months of inventory in the luxury segment, far beyond a balanced market. Mortgage rates above 7% have further reduced affordability, even for households that would have seemed ideal buyers just a few years ago. On top of that, ownership has become more expensive. A $2 million property now carries annual property taxes exceeding $20,000, while insurance for flooding, wind, and wildfire risk can tack on another $7,000 or more. Monthly carrying costs that averaged around $6,000 in 2021 are now approaching $9,000. Tourism and short-term rentals were once seen as a financial safety net. Many investors relied on a constant flow of visitors to generate income from luxury units. By 2026, however, occupancy for high-end Airbnb listings has dropped roughly 20% in some areas, and the oversupply of rental units means more homes sit empty. Foreclosures are no longer confined to modest neighborhoods. Upscale communities like Summerlin and Henderson are seeing increasing numbers of distressed sales, as owners who overextended during the boom discover how quickly small shifts in occupancy, nightly rates, or expenses can create large financial gaps. Beneath the neon lights, Las Vegas faces a different kind of gamble. The city still sells visitors a dream, but in the luxury housing market, more sellers are leaving the table with losses instead of jackpots. Number 2. San Diego, California. For years, San Diego was considered the quieter, more understated cousin to Los Angeles when it came to luxury real estate. Think beachfront estates in La Jolla, dramatic homes perched above the ocean in Del Mar, and high-end condos offering sweeping harbor views. The city attracted wealth, but in a more relaxed, less flashy way. By 2021, luxury property prices in the region peaked around $2.4 million. Fast forward to 2026, and that median has fallen to roughly $1.95 million, a decline of about 19%. At the very top end, estates listed above $8 million are now trimming $1.5 to $2 million just to attract serious buyers. The reasons are clear: rising ownership costs and growing inventory. On a $5 million estate in La Jolla, property taxes alone can exceed $55,000 annually. Add insurance for wildfire, coastal exposure, and storm damage, which now often tops $25,000 a year, and the numbers climb even higher. With mortgage rates lingering above 7%, monthly payments that hovered around $12,000 in 2021 can now approach $18,000. Meanwhile, the supply of luxury homes keeps building. Properties that previously sold within weeks are now lingering on the market for 5 months or more. Sellers are responding with price cuts, generous credits, and occasionally extra incentives like vehicles or club memberships. Even with these sweeteners, many buyers remain cautious, hesitant to commit in a market that has already begun to decline. The traditional safety net of vacation rentals is losing effectiveness. Demand for high-end short-term rentals has softened, with occupancy for some luxury units dipping below 50%. Rents that once covered most carrying costs now leave a noticeable gap. Foreclosures are quietly starting to appear in some of San Diego's most exclusive neighborhoods. Households that stretch to purchase $3 million to $5 million homes are now grappling with higher rates and lower property values, eroding or even eliminating their equity cushions. San Diego hasn't lost its coastline, climate, or lifestyle. The beaches and ocean views remain stunning. What has shifted is the math. High purchase prices, elevated ongoing costs, and a smaller pool of qualified buyers have turned what was once considered a safe blue-chip luxury market into one carrying significantly more risk. Number 1. New York City, New York. For decades, New York City has stood at the very pinnacle of global luxury real estate. Think Central Park penthouses with sweeping views, classic townhouses lining the Upper East Side, and sleek glass towers rising along Billionaires Row. Purchasing property here was never just about shelter. It was a symbol of status, and for years, it was widely regarded as a safe store of wealth. Luxury home prices reached their peak around 2020, with medians hitting roughly $4.5 million. By 2026, that figure has fallen to about $3.55 million, a decline of roughly 21%. At the extreme upper end, penthouses that once listed for $50 million are now cutting $10 to $15 million and still remain unsold. Multiple pressures are converging on the market. Years of construction created a deep pipeline of ultra-luxury condos, particularly in towers designed for billionaires. That surge in supply collided with some of the highest carrying costs in the nation. On a $10 million condo, annual property taxes can reach $200,000. Monthly association fees often exceed $5,000, and in full-service buildings the costs can be much higher. Insurance expenses continue to rise, and mortgage payments on $20 million properties are stretching even the budgets of very high-income households. Meanwhile, demand is softening. Wall Street bonuses have become more volatile, and international buyers have pulled back due to currency swings, capital controls, and global uncertainty. Remote and hybrid work arrangements have weakened Manhattan's role as the mandatory home base for top earners. In the ultra-luxury segment, inventory has ballooned to nearly 14 months of supply, a sharp reversal in a market that once boasted waiting lists and instant sales. Many towers now appear dark at night, with units empty or rarely occupied. High-end rents have softened, vacancies are rising, and investors who relied on strong corporate or luxury rental demand are either lowering rents or enduring extended gaps without tenants. Some are even exiting the market at a loss. Foreclosures, once almost unthinkable at this level, are beginning to appear in public records. The skyline that once symbolized limitless demand now tells a different story. Dark glass and unsold units serve as tangible reminders of a market cycle that overshot. New York's luxury downturn is not just a minor correction. It represents a reset of wealth at the very top and serves as a warning for the broader luxury real estate landscape. From Dallas to New York, from Miami to San Francisco and beyond, The same pattern is repeating: price reductions, rising carrying costs, growing inventory, and the emergence of foreclosures in neighborhoods once considered untouchable. The long-held assumption that luxury real estate is a guaranteed safe haven has been shattered. This time, the top end is taking the hit first. The only remaining question is, which market will be next? This is Discover the Cities. If this breakdown helped you see what's really happening beneath the headlines, subscribe now so you don't miss our next deep dive into the fastest changing housing markets.